Right, guys, now we're going to be looking at acquisition, but before we jump into the consolidated financial statements, let's have a look and see what happens when H acquires S in H's separate financial statements and in S's separate financial statements, and then we'll see how that makes sense in context of the consolidation. Okay, so firstly, let's look at H. H buys 80% of S, let's say for 120 Rand. So when H buys 80% of S in H's financial statements, what does that mean to H? It means that H has acquired an asset, right? And how did it acquire this asset? Well, it paid 120 Rand in cash for it. So it acquired an asset and it paid cash for it. If we're looking at H's financial statements in terms of IFRS, when we identifying which standard to use to account for this asset, we need to see what type of an asset it is. Because this is an investment in shares, it's the investment in the shares of S, it's the investment in the equity instruments of another company, it is then seen to be a financial asset. Now, in terms of IFRS, financial assets, we record in terms of IFRS 9, and we have two options. We can either account for them at fair value through profit or loss, or at fair value through other comprehensive income. But now IFRS also sees that this investment that H has in S, it's a huge investment. It's enough to give H control over S. And because H has control over S, it allows H an exemption in its financial statements. It says, you don't have to record your investment in H at using IFRS 9 as a financial asset. We will allow you to record this investment also at cost. So in H's financial statements, quite simple. They can either record the investment in the subsidiary at cost, at fair value through profit or loss, or at fair value through other comprehensive income. Now, the amount that H paid to acquire S, this 120 Rand, this is the cost amount. And if we're looking at fair value, then we would be looking at the value of this 80% in S. So let's assume, for the purposes of this example, that the value of S at acquisition date was 120 Rand as well, which means that the fair value and the cost are equal in this specific example. Now let's go and do the journal entry. In H, how would H be recording this in terms of journal entries? They're acquiring an asset, so they're going to debit an asset, investment in S. This is going to be in the statement of financial position. They are paying cash for it. So this is also going to be in the statement of financial position. Here, the cost is 120 if we're using the cost method, and the fair value is 120 as well if we're using the fair value method. So this journal entry is the same regardless of whichever approach we are using. Now, for purposes of tests and exams, you're going to mostly encounter cost or fair value through OCI as the two types of accounting treatment that H is going to use to account for its investment in S. So we're going to just go through an example using OCI. Obviously, if it's at cost, once this journal is done, you are done. All you have to do is then consider impairment in future years. If your accounting policy choice is to account for this investment at fair value through OCI, you need to then have a look every year or as often as possible and see, well, what is this movement? What is the fair value and how has the fair value moved? So let's say at the end of the year after acquisition has happened, the value of S has now moved to 150. So it was 120, it now increased to 150. How would we take that into account in H Limited's financial statements? In our journal entries, we would increase the value of the investment because the value has increased. So we would debit investment in S in our statement of financial position. Now it increased from 120 to 150, so the increase is going to be 30. Now, because we have chosen to record the fair value through OCI, our credit is going to be our mark-to-market reserve, and that is going to be through OCI, and it's going to be for the 30. Now, as soon as we have revaluations or fair values, then we need to consider the deferred tax. You should always just be writing out the journal entry, debit deferred tax, credit deferred tax, and then I'll show you a quick trick about how to allocate to which statement this deferred tax is going to go to. If your revaluation, the debit is in statement of financial position, then the deferred tax entry, the credit is going to go to statement of financial position. If in your fair value adjustment, your debit is through OCI, then your deferred tax entry, if the credit is through OCI, then in your deferred tax entry, the OCI, the deferred tax debit is going to be through OCI. Okay, so how do we calculate the deferred tax? We're going to take the revaluation amount, we can take the fair value increase, multiplied by the capital gains tax inclusion rate, because we're going to probably recover this value, thinking about it from H Limited's separate financial statements perspective. They're only going to recover this value once you sell the subsidiary, so you're going to recover it through capital gains, and that's why you're going to use the capital gains tax rate times by the normal tax rate, and that is going to give you an amount of 7. Okay, so we're happy with how the acquisition of S Limited is accounted for in the H Limited separate financial statements. Now let's have a look at S Limited. Well, what happens in S Limited when this transaction happens? So we have exactly the same scenario. We have H acquiring 80% of S. But who does H acquire S from? Does it pay S the 120 Rand? No, it doesn't. When H acquires S, it acquires it from the previous shareholders of S. So the previous shareholders held 100% of S, but H approached them and asked them if they would sell 80% of S. They agreed. The sale happened. So H paid 120 Rand to those previous shareholders. They now no longer hold 100%. They only hold 20%, and now H holds 80% of S. So as you can see, what happens in S? Nothing. S doesn't issue any new shares. S doesn't receive any money. The previous shareholders are the company that are receiving the money, and H is the company that receives the shares in S from those previous shareholders as well. Within S, absolutely nothing happens. So there's no change in the assets, liabilities, equity of S, nothing at all. Now I just want us to talk a little bit about this price here. When H purchases these shares from the previous shareholders of S, it is essentially purchasing their entire equity interest. So we're saying that we're purchasing only the shares, but they're not purchasing just the shares. They're purchasing the shares as well as any income and any reserves that S has incurred up until that date. So they're purchasing the entire equity interest of those shareholders. These shareholders, they're saying that their equity interest in S is worth 80% of their equity interest in S is worth 120, and that's what they're going to sell their equity interest in S to H for. Okay, so we say that it is the purchase of the share capital or purchase of the shares, but it's not just the shares that are being purchased. It is the entire equity interest, or 80% of the equity interest that is being purchased. Okay, so now we have the journal entry that we did previously in the holding company books, where we had debit investment in S Limited, statement of financial position, cash, statement of financial position of 120, and we had the increase of 30 and the deferred tax of 7. In share capital, retained earnings and reserves, there is no change at all. There's no change in S Limited. There's no journal entry that happens in S Limited. But we know that when H Limited purchases the 80% interest in S Limited, that it is not just buying the share capital. It's buying the share capital as well as all of the other equity within S Limited.